Okay. And then as far as the NASDAQ fund is concerned and the S&P 500 fund is concerned, being leveraged, just so that the audience maybe try to understand exactly what kind of leverage is being used here. Is this the classic leverage? Is this the sort of more derivative style of leverage where I think it involves swaps and other mechanisms to generate that kind of leverage?
Yeah, so the underlying ETFs, they're in the case of the broad indexes, those are 3 times levered ETFs. So for the NASDAQ, for example, the most popular product is TQQQ is a ticker code, and that's a 3 times leveraged ETF on the NASDAQ. Now, that works by providing 3 times the return of the NASDAQ on a daily basis. So if the NASDAQ goes up by 2% in a day, then TQQQ will go up by 6% in a day. And that's obviously before fees, but the way that leveraged ETFs maintain or obtain their exposure is through a type of derivative contract called a swap, which is just a financing mechanism whereby the fund is effectively borrowing money from an investment bank to finance those particular positions. So that's the underlying ETF. And then because those ETFs are so heavily traded, that you have an options market that then develops on those ETFs. So a lot of investors in the market, and this is where it's covered call strategies have come from anyway, a lot of investors in the market sell options or buy options on these leveraged ETFs anyway. Mm-hmm. And then what YieldBoost does is package that together by using slightly different options. We use flex options, which are bespoke contracts, the European style, and then we roll those on a weekly basis. But the actual ETF itself, again, is not leveraged. It just sells options, but the exposure is coming from underlying leveraged ETFs.
Okay. And you know what? And this is for maybe for a portion of the audience that, that they're more of, for lack of a better term, more of like the couch potato style of investor. They just kind of one and done, don't want to really think about it, but they like the idea of getting, a distribution every month, or maybe it's weekly. As far as a daily leveraged funds are concerned, now are these meant to be held long term, like instead of say just for the day? What happens if you hold, say, a leveraged ETF with the way in which it generates it, or the way in which it generates its leverage? Is it meant to just be held for just a day? Can it be held for essentially infinitum?
Well, they're designed, so the investment objective is to deliver a daily return. And the reason for that is because the leverage gets reset at the end of each day. So that means that on any given day, whether you buy it today, whether you buy it in 6 months' time or 6 years' time, you're getting the stated leverage factor, which is 2 times or 3 times. And you do that by rebalancing and rehedging at the end of each day. The consequence of doing that is that over time, when you rebalance every day, instead of once a quarter or once a year, the return that's generated is going to deviate from what we call the cumulative return of the underlying. So for example, if you have a NASDAQ and like last year, for example, you say, well, the index was up around 20% over the course of a year, then a 2 times leveraged ETF will almost certainly not be up exactly 2 times. It might be more than 2 times or less than 2 times. And that's called something called path dependency. And the reason for that is because when you rebalance every day, it takes on the path of the rebalancing, which, depending on the underlying stock price, can mean that from the actual cumulative, the 2 times or 3 times cumulative return. So while the investment objective is daily, what we say to people is that for people that use these products, you should be monitoring it, or you should use them with a view to monitoring it every day. That doesn't necessarily mean that you can't hold it for long periods, but it's not advised, because the longer you hold it, the less predictable the final return becomes, if that makes sense. So the shorter you hold it, the more that you look at it, probably the better chance you're going to have of it matching something like the cumulative return. But it really depends on what the stock is doing in the market or what the index is doing. So what these products really like is a momentum-driven market. In other words, where you have a trend in one particular direction. So obviously, if you're long, 2 times long or 3 times long, and the underlying index is racking up cumulative wins every day, that's a period that it likes and most likely will lead to outperformance. But consequently, the environment which it doesn't like is that sort of choppy market where it's going up and down every day.
I see. You know what? I think that's really going to help out the audience a lot. I get a lot of questions about the daily leverage type of stuff. So having a little bit more wherewithal as to how to handle it over a specified duration, I think will kind of help the audience sort of more or less maybe feel like a little bit more comfortable where they can say, oh, okay, so I don't have to just hold this for a day, because I think that's going to be sort of the first thought if they have some form of wherewithal as to, what.
Yeah, I mean, what you're effectively doing, Jordan, is you're trading off the biggest sort of pain point of investing with leverage in a traditional sense in a margin account, and that's margin itself and margin calls. So when you have traditional leverage, you have to put up margin. And depending on the movement of the stock, of the index on a given day, you might be called by the broker for more margin, which means that you're putting more money into the position. And a lot of people lose money because they get margin called when it unfortunately goes the wrong way, and you might have no more collateral kind of in your account. So with leveraged ETF, you take away that, and so it's fully paid. In other words, you buy the ETF and you can hold it. You're in control of when you buy and when you sell, but the trade-off is that margining is being done within the ETF, not by you. And so when you rebalance every day, there is a trade-off, which means that the portfolio takes on this path dependency, and you don't get that 2 times or 3 times linear return over time, but you don't have to pay margin.